Imagine waking up one morning, walking to an ATM, punching in your PIN, and the machine just stares back at you. No error message. No insufficient funds warning. Just nothing. Your money is there, you can see it on the screen, but you cannot touch it. You cannot move it. You cannot spend it. And the scariest part? The bank hasn't technically stolen it. They've just converted it into shares of themselves, of a bank that is currently collapsing. Congratulations. You are now a shareholder in a sinking ship, and nobody told you that was part of the deal when you opened your account. This is not a horror movie plot. This is not some far-fetched dystopian fantasy. This is the legal framework that governs your money right now. And it has a name. It's called a bail-in. And before this video is over, you're going to understand exactly how $256.8 trillion in shadow debt, money that exists in a parallel financial universe most people have never heard of, could reach through the wall of your local bank branch and touch your savings account directly. So let's start at the very beginning, because to understand where we are, you need to understand how we got here. Cast your mind back to 2008. The global financial crisis. Banks are collapsing. Lehman Brothers is gone. The entire world economy is teetering on the edge of an abyss. And what does the government do? It reaches into the pockets of ordinary taxpayers and shovels trillions of dollars into the balance sheets of the very institutions that caused the problem in the first place. The public was furious. And rightly so. Hardworking people who had nothing to do with mortgage-backed securities or collateralized debt obligations or any of the other exotic financial weapons of mass destruction that Wall Street had been playing with, those people ended up paying the bill. And the bankers kept their bonuses. So regulators decided, never again. They built new rules, stricter capital requirements, higher liquidity buffers, the Basel III framework, which forced banks to hold more equity against their loan books. The idea was simple: make banks safer, make them hold more cushion, and if they still fail, don't use taxpayer money to save them. Instead, let the bank save itself by converting its debts into equity. Make the creditors pay. Make the bondholders pay. And yes, if it comes to it, make the large depositors pay. That framework is what we now call the bail-in regime. And it is sitting quietly in the background of every bank account holding more than $250,000 in the United States, or the equivalent threshold in Europe. A ticking legal mechanism that almost nobody who uses a bank has ever read about. But here's the thing that makes this even more interesting and significantly more dangerous. The Basel III rules that were supposed to make banks safer did something else entirely that nobody planned for. They made banks less profitable in certain kinds of lending. And so the banks did what any rational profit-seeking entity does when you change the rules of the game. They found a way around them. They started moving risk off their balance sheets and into a shadow system, a parallel financial universe that operates without capital requirements, without deposit insurance, without direct access to central bank backstops, and crucially, without the kind of regulatory transparency that lets anyone see what's actually happening inside it. This shadow system has been growing for years. But the numbers we're talking about now are so large they almost defy comprehension. We are not talking about a few $1 billion. We are not even talking about a few trillion. The global non-bank financial intermediation sector, which is the technical, polite name for what most people call shadow banking, reached $256.8 trillion in 2024. That is $256.8 trillion. And it grew at 9.4% in a single year. That is exactly double the growth rate of the regular, boring, regulated banking sector you actually know about. Shadow banking is now 51% of all global financial assets. More than half. The shadows have eaten the sunlight. Now, let's talk about what actually lives inside the shadow. Because when people hear shadow banking, they often imagine some kind of criminal underworld, briefcases full of unmarked bills, offshore accounts in the Cayman Islands. That is not what this is. This is your pension fund. This is the insurance company that holds your life insurance policy. This is the hedge fund your university endowment allocates to. This is the asset manager running the fund your 401k quietly invests in. These are legitimate, sophisticated, legal financial entities. But they operate outside the protective membrane of bank regulation. And that distinction, legal but unprotected, is what makes this entire system so exquisitely dangerous. The fastest growing part of this shadow universe is what regulators call other financial intermediaries: hedge funds, money market funds, structured finance vehicles, trust companies. This segment alone swelled to $169.4 trillion, growing at 11% in a single year. And then there's the narrower slice that regulators are most worried about, the part they specifically identify as conducting bank-like activities with bank-like risks, but without bank-like safety nets. That slice is $76.3 trillion and growing at 12% a year.
Think about that.
The most dangerous part of the most dangerous financial sector in the world is growing the fastest. This is not a footnote. This is the main story. But here's what really connects all of this to your savings account. Shadow banking entities and regular banks are not separate worlds. They are deeply, intimately, legally entangled with each other. Banks provide credit lines to shadow funds. Shadow funds buy securities issued by banks. Banks securitize loans and sell them to shadow vehicles. Shadow vehicles use those securities as collateral for more borrowing from banks. And around it goes, in a circle of interconnectedness so dense and so opaque that even the people running these institutions don't always know the full extent of their exposures. The Financial Stability Board, which is the international body that monitors this stuff for the G20, calls this a corporifery network. The regulated banks are at the center. The shadow entities swirl around them, and during normal times the whole thing spins beautifully and makes everyone rich. But during a crisis, the core banks become the rescuers of last resort for the periphery, and that is where the contagion comes in. Because if the shadow entities fail big enough, the banks absorb the shock, and then the depositors absorb the shock from the banks. Let's get specific about how this contagion mechanism actually works, because the mechanics are fascinating and terrifying in equal measure. When markets are calm, certain financial instruments, short-term loans between institutions, repurchase agreements, asset-backed commercial paper, function like cash. Everyone accepts them. No one asks too many questions about what's underneath, because there's no reason to. These instruments are what economists call informationally insensitive. You don't need to investigate them. You just use them like money. But the moment a credit shock hits, the moment someone starts wondering whether the collateral backing these instruments might be rotten, everything changes instantly. Suddenly, these instruments become informationally sensitive. Suddenly, everyone wants to know what's inside them. And because they're complex, opaque, structured products, nobody can figure it out fast enough. So the market doesn't slow down. It stops. Completely. This is what happened in 2008 with mortgage-backed securities. And the conditions for it happening again in private credit, in leveraged loans, in structured finance vehicles are being assembled right now. Here is a number that should make every corporate treasurer in the world sit up very straight. Regulated commercial banks have provided at least $220 billion in revolving credit lines directly to private credit funds. That's the number regulators can see. The actual number, based on commercial market data, is almost certainly north of $500 billion. These credit lines are called back leverage or subscription credit lines, and they allow private credit funds to borrow from banks to amplify the returns on their own lending. It is leverage on top of leverage. The funds borrow from banks to lend to companies, and when those companies get into trouble, the value of the loans the funds hold goes down, which means the collateral they've pledged to the banks goes down, which triggers margin calls from the banks, which forces the funds to sell assets or gate redemptions to raise cash, which spreads the distress further. And at the end of that chain, if the banks end up holding deteriorating collateral they can't sell, their own capital ratios suffer. And then the bail-in mechanism gets a little more relevant to people like you and me. Now, let's talk about private credit specifically, because this is the rocket ship that turned into a slow-motion crash test. Private credit is essentially direct lending, non-bank asset managers lending money to medium-sized companies, cutting out the bank intermediary entirely. In 2020, this was a $2 trillion market. By the end of 2025, it had blown past $3 trillion. The growth was staggering and the appetite was insatiable, driven by a very simple dynamic. In a world of near-zero interest rates, everyone was desperate for yield. Pension funds needed returns to meet their obligations. University endowments needed returns to fund their spending. Insurance companies needed returns to cover their liabilities. And private credit offered those returns at the cost of liquidity. You couldn't get your money back whenever you wanted, but the yields were there. So pension funds piled in. Endowments piled in. And this is where things get really interesting, private equity firms started acquiring insurance companies specifically to get access to the insurance liabilities as a source of cheap, long-term funding for their private credit operations. Nearly $900 billion in insurance liabilities are now managed by private equity-linked insurers. These aren't fly-by-night operations. These are serious, sophisticated financial actors. But they have fundamentally changed the character of the insurance industry and created new channels through which private credit distress can spread to policyholders. And the distress is coming. The signs were there for anyone who looked. As asset managers scrambled to deploy the enormous amounts of capital flooding into private credit, underwriting standards quietly deteriorated. Companies that wouldn't have qualified for loans a decade ago were getting them easily. Leverage ratios. The ratio of debt to earnings climbed to 5x, 6x, even 7x adjusted EBITDA. And adjusted EBITDA is its own little piece of financial fiction. Strip out all the inconvenient one-time costs that seem to happen every single quarter, and suddenly the company looks much healthier than it actually is. True distress in private credit, incorporating not just outright defaults but selective defaults, payment-in-kind arrangements where companies skip cash interest payments and just add to their debt pile, and distressed restructurings, climbed to around 5% of the market. That's not a rounding error. That's a problem. The dam started cracking publicly in late 2024 and early 2025. Tricolor Holdings, a subprime auto lender, ran into severe funding trouble. That alone wasn't catastrophic. But then First Brands Group, an auto parts supplier, was accused of something far more alarming: double pledging, taking the same physical manufacturing assets and using them as collateral for loans from multiple different lenders simultaneously. That is, to use a technical term, fraud. And then in late 2025, London-based property lender Market Financial Solutions, which had built a loan book of $3.2 billion, collapsed amid allegations of fraud and a collateral shortfall estimated at over $1 billion. That is a lot of money that lenders thought was backed by real estate that turned out to be not backed by real estate. These events triggered something the private credit market had been quietly dreading: retail redemption waves. Because here's the thing that happened during the boom years. Asset managers needed to keep growing their private credit funds, and institutional capital alone wasn't enough. So they opened the doors to retail investors. They created evergreen funds structured with quarterly redemption windows instead of the long lockup periods traditional private credit funds used. They created perpetual business development companies, listed vehicles that let ordinary wealthy individuals invest in private credit. They marketed these products to the private wealth channel, the financial advisors who serve high-net-worth individuals and families. And when things started going wrong in late 2025 and early 2026, all those retail investors wanted their money back at the same time. The problem, of course, is that private credit funds hold illiquid assets. They hold loans to medium-sized companies that are not publicly traded, that cannot be sold on an exchange, that take months to restructure or transfer. You cannot liquidate a $200 million loan to a software company in Louisville in 24 hours to meet redemption requests. You can't even do it in a month. So when redemption requests flooded in during early 2026, fund managers did the only thing they could do. They gated withdrawals. They invoked the structural limits in their fund documents that allow them, under certain conditions, to restrict how much investors can take out in any given quarter. Private wealth flows across private products fell 19% in the first quarter of 2026 alone. 19%. In one quarter. Blue Owl Capital Corporation II, one of the largest and most established names in the direct lending space, announced in February 2026 that it was permanently suspending its quarterly redemptions. Permanently. Not gating temporarily while it managed liquidity. Permanently suspending them. And to raise cash, it sold $1.4 billion worth of direct lending assets out of 3 of its private debt funds. Its shares dropped nearly 6% on the news. For a fund that had been marketed partly on the basis of its stability and liquidity management, This was a significant moment. At Apollo, John Zito, the co-president of asset management at one of the most powerful private equity firms in the world, made a public statement that should have landed much harder than it did. He said, essentially, that the private marks on private equity software investments were wrong. All the marks are wrong, is how he put it. Private markets, unlike public markets, don't reprice daily based on trading. Fund managers value their own assets, a process known as marking, and those marks can stay elevated long after the underlying reality has deteriorated. Zito was warning that private credit lenders in software companies could face recoveries of just 20 to 40 cents on the dollar, meaning for every dollar they lent to software companies, they might get back between 20 and 40 cents. The rest is gone. And this isn't a small slice of the market. Software loans constitute approximately 20% of the entire private credit lending universe. Why software? Because during the cheap money era of 2020 to 2023, software companies were the darlings of private credit. They had recurring revenue, subscription streams that looked steady and predictable. They didn't need factories or warehouses or physical infrastructure. They were capital light. They scaled beautifully. Private credit funds loaded them up with debt, charging floating rate interest, meaning the interest rate moved with the broader market, not fixed at the time of the loan. And then interest rates went up sharply. And then, in 2026, something even more devastating happened to software companies than rising rates. Artificial intelligence ate their lunch. Generative AI tools, the kind built by companies like OpenAI and Anthropic, didn't just compete with traditional software. They automated the workflows that traditional software was built around. A company that had been selling a workflow management tool for $500,000 a year suddenly found that their clients could do the same workflow with an AI agent for $50,000 a year. Or less. The revenue models of hundreds of software companies that had borrowed billions of dollars from private credit funds collapsed. The borrowers defaulted. The funds were left holding loans to companies with no earnings, no hard assets, and no recovery value to speak of. 20 to 40 cents on the dollar, if they were lucky. And here is the final twist that makes this particular moment uniquely strange. Private credit is simultaneously being destroyed by AI on the software lending side and betting everything on AI on the infrastructure side. Private credit's share of AI-related financing deals reached 34% in 2025. There is an estimated $800 billion of AI infrastructure capital expenditure projected through 2028, and private credit is expected to fund a significant chunk of it. Data centers, power infrastructure, GPU clusters, fiber networks, all of it needs financing, and private credit is rushing to provide it. Whether the returns justify the risk in a sector moving this fast, with technology changing this dramatically, with capital costs this elevated, is a question nobody has a confident answer to. Now, let's bring this all the way home. Let's talk about what all of this means for your money specifically. And let's talk about the mechanism by which losses in a $256 trillion shadow system could reach your savings account. When a private credit fund's assets are marked down, when the loans it holds are recognized as worth less than they were previously valued at, the banks that provided back leverage to those funds get nervous. Under the terms of the credit facilities, there are margin maintenance covenants. These are legal tripwires. When the value of the collateral falls below a certain threshold, the bank issues a margin call. The fund has to post more cash immediately. If it can't, because its cash is locked up in illiquid loans and its redemption gates are closed, the bank seizes the collateral. And now the bank is sitting on deteriorated assets it didn't want and didn't plan for. The bank's own capital ratios suffer. And the bank, which is a regulated institution that regular people and companies bank with, becomes less stable. This is exactly why JP Chase, the largest bank in the United States, started reducing its back leverage exposure to private credit clients in March 2026. They started marking down the value of software loans pledged as collateral and pulling back the credit lines extended to private credit funds. They could see what was coming, and they wanted to be less in the path of it, which, of course, accelerated the liquidity crunch for the funds that were losing access to JP Morgan's credit lines. And when a big enough bank gets into serious trouble, not just a bad quarter, but genuine solvency risk, the bail-in mechanism activates. Under the Dodd-Frank Act in the United States and the Bank Recovery and Resolution Directive in Europe, the process is legally prescribed. The bank holding company goes into receivership. The Resolution Authority in the U.S., that's typically the FDIC, takes control. And then the losses are allocated in a strict legal hierarchy. Shareholders get wiped out first, then junior bondholders, then senior bondholders, and general unsecured creditors. And here is the part that most people have never read in the fine print of their bank account agreement. Any deposit over $250,000 is legally classified as senior unsecured debt. Your cash becomes a creditor claim, a claim that can be haircut or converted into equity while you watch. And here's the detail that is genuinely shocking once you understand it. Derivatives counterparties, the banks and funds that have interest rate swaps, currency swaps, and other complex financial contracts with the failing bank, get super priority under Dodd-Frank's Qualified Financial Contracts rules. They get paid first, before the bondholders, before the unsecured creditors, before the big depositors. The bank's derivatives book, which at a major global bank can be hundreds of billions of dollars in notional value, effectively stands ahead of you in the queue for whatever assets are left in the estate. So if you are a company with $50 million sitting in a business checking account at a bank that enters resolution, here is what your morning looks like. The FDIC freezes your uninsured balances, everything over $250,000. The resolution process works through the bank's capital stack. The derivative counterparties get settled. The bondholders get their haircut. And whatever is left, if anything is left, gets distributed to unsecured creditors, including you. Or your $50 million gets converted into equity shares of the newly restructured bank, shares that you cannot sell easily, that are liquid, and that are worth some fraction of what you deposited. You do not have access to your operating cash. Your payroll is due on Friday. Your suppliers want payment by end of month. And your money is locked inside a restructured financial institution while lawyers and regulators work through the resolution process. This is not hypothetical. This is the architecture that currently exists. The question is simply whether the chain of events that would trigger it will actually unfold. So what do? What can actually be done to protect large cash balances from this risk? The first line of defense is multi-bank sweep networks. The IntraFi network, the largest of its kind, operates through services called the Insured Cash Sweep and the Certificate of Deposit Account Registry Service, or DARS. Here is how they work. You deposit $10 million into your primary bank. The bank's software automatically carves that $10 million into chunks of $245,000, just under the $250,000 FDIC limit, with room left for accrued interest. Each chunk is swept into a separate FDIC-insured account at a different network bank. You get one statement, one relationship, one point of contact, but your $10 million is spread across dozens of institutions, each chunk fully insured. The practical FDIC insurance coverage is extended from $250,000 to millions of dollars just through intelligent architecture. This is not exotic. This is available to businesses and high-net-worth individuals right now. The DARS version works the same way, but puts the money into certificates of deposit, term deposits that earn interest but are locked up for a defined period, from 1 month to several years. Less liquid, but you earn a return and you have the same insurance protection. But these services have limits. The practical capacity of sweep networks is roughly $100 million for most depositors. Beyond that, if you're a corporate treasury with hundreds of millions in operating cash, or a family office with very large liquid reserves, the most structurally sound option is to bypass the banking system entirely and hold short-term U.S. Treasury bills directly. T-bills are direct obligations of the federal government. They are backed by the full faith and credit of the sovereign. There is no bank counterparty. There is no bail-in risk. There is no derivatives priority queue. The only risk is that the U.S. government itself defaults, and if that happens, the FDIC insurance fund is also worthless, so you have bigger problems regardless. There is one thing depositors absolutely need to watch out for, and it goes by the deceptively benign name of Yankee Sweep. These services are marketed to institutional clients as a way to sweep excess cash into U.S. domiciled branches of foreign banks for a slightly higher yield. The pitch sounds fine until you look at the fine print. Yankee sweep deposits are completely uninsured by the FDIC. The deposits sit at a U.S. branch of a foreign bank, and branches, unlike subsidiaries, are not separate legal entities. They are part of the foreign parent. If that foreign parent runs into trouble, your Yankee sweep deposit is exposed directly to the credit risk of an overseas institution. No FDIC. No bail-in protection for insured amounts. No safety net at all. The yield premium is not worth that. There is also a regulatory wildcard in play. The FDIC has been working on rulemaking under the reference number RIN 3064, AF 99, that would tighten the definition of broker deposits. Why does this matter? Because the sweep networks that provide multi-million-dollar FDIC coverage rely on certain regulatory exceptions to function without being classified as broker deposits, which come with additional costs and restrictions. If those exceptions get narrowed, and the proposed rules include a no additional third parties clause that could do exactly that, the economics and availability of sweep products could change materially. This is not imminent, but it is a reminder that the rules governing your cash can change, and when they do, the structures you rely on may need to adapt. Let's zoom out for a moment and look at the even bigger picture, because there is one more layer to this story that does not get nearly enough attention, and it is genuinely alarming on a civilizational scale. Commercial banks, under increasing pressure from regulators and shareholders to reduce their exposure to carbon-intensive industries, to green their balance sheets, have been quietly solving that problem in a very creative and very troubling way. They have been securitizing their brown loans, taking the loans they made to oil companies, steel manufacturers, coal miners, heavy industrial companies, the high-emission borrowers, and packaging them into special-purpose vehicles that sell bonds to investors. The bank removes the climate risk from its balance sheet. The loan goes into the shadow system. The shadow system, hedge funds, collateralized loan obligations, private credit vehicles, absorbs the exposure. So when you look at a major bank's climate disclosures and see that they're meeting their net zero lending targets and their carbon intensity metrics are improving, understand what you're actually seeing. You're seeing accounting. You're seeing the visible part of the ledger. The actual loans to carbon-intensive companies still exist. The money is still flowing to those industries. The emissions are still happening. The transition risk is still building. It's just been moved to a part of the financial system with less visibility, less regulation, and less capacity to absorb losses if those assets suddenly get repriced when the energy transition accelerates. And when stranded assets, fossil fuel infrastructure that can no longer generate economic returns in a decarbonizing economy, suddenly need to be marked down, the losses will crystallize in the shadow system. And the shadow system will reach back into the regulated banking system. And the chain of contagion will follow its now familiar path toward depositors. The Financial Stability Board has been sounding the alarm in increasingly urgent language. Its December 2025 Global Monitoring Report documented not just the scale of the NBFI sector, but the specific risk events of 2024 and 2025 that demonstrated exactly how vulnerable this system is. The August 2024 market turmoil, triggered by shifting monetary policies and thin liquidity in secondary markets, showed how rapidly hedge fund deleveraging can amplify volatility across the entire financial system. The April 2025 market disruptions following U.S. tariff announcements exposed structural vulnerabilities in U.S. Treasury and swap markets that cascaded through non-bank entities and shifted risk across borders. These were not catastrophic events. They were stress tests that the system survived. But they revealed the fault lines clearly, and those fault lines have not been repaired. Dutch pension funds are in the middle of a massive structural reform, transitioning from defined benefit models, where retirees receive a guaranteed income, to defined contribution models, where individuals bear the investment and longevity risk themselves. This shifts hundreds of billions of euros in investment risk from institutions that can absorb long-term volatility to individuals who cannot. More retail savers are being exposed to market risk precisely as market risk in the shadow banking sector reaches elevated levels. Meanwhile, the rating agencies, the gatekeepers that are supposed to provide independent assessment of credit quality, are facing their own credibility problem. Smaller, lesser-known rating agencies are increasingly providing private ratings for insurance company portfolios. These ratings are used by insurance regulators to determine capital requirements. A lower-rated asset requires more capital to hold. A higher-rated asset requires less. If those ratings are inflated, if assets are being rated better than they actually are, then insurance companies are holding less capital than they should against assets that are riskier than advertised. This is the same dynamic that played out with structured finance ratings in 2006 and 2007, and we all know how that story ended. So where does this leave us? We are living in a financial world where the shadow banking sector has grown to $256.8 trillion, more than half of all global financial assets, while operating with minimal regulatory oversight, opaque valuations, and deep interconnections to the regulated banking system. The private credit market is in the early stages of a credit stress event concentrated in software loans, driven by the collision of high leverage, rising rates, and AI-driven revenue disruption. Retail investors who are attracted to private credit's yield premium are discovering that liquidity promises made in good times evaporate in bad ones. Banks are pulling back credit lines as they recognize the deterioration in their shadow counterparties' collateral. And the legal framework that governs bank resolution is explicitly designed to make large depositors absorb losses before taxpayers do. None of this means that the entire global financial system is going to collapse tomorrow. Financial systems are resilient, regulatory responses will emerge, and the largest institutions have more capital than they did in 2008. But it does mean that the comfortable assumption that your money is simply safe in a bank, fully insulated, fully protected, fully liquid, deserves to be examined more carefully than most people have examined it. The ghost economy is real. It is vast. It is growing faster than the real economy. And it is connected to your savings account through channels that are invisible until they aren't. The time to understand those connections and to take the straightforward, available steps to protect your capital is before the crisis, not during it. During the crisis, the gates close. The freezes happen. The lawyers get involved. And the only thing worse than losing money is losing money you thought was protected. The $250,000 FDIC limit exists because that is where the government decided to draw the line between who gets protected and who takes the loss. Everything above that line is in play. Everything above that line, in a bail-in resolution, is a creditor claim, subordinate to derivatives, subordinate to secured debt, convertible into equity at the discretion of regulators managing a crisis in real time. Sweep networks, T-bill portfolios, diversified treasury structures. These are not exotic hedging strategies for paranoid billionaires. They are rational responses to a legal framework that most depositors don't know exists, sitting on top of a financial system that is larger, more complex, and more interconnected than at any previous point in history. The ghost economy is not haunting the future. It is operating in the present, right now, in real time, at a scale that would have seemed impossible 15 years ago. And the question every depositor, every corporate treasurer, every institutional allocator needs to sit with is a simple one. Do you know where your money actually is, and do you know what happens to it if the institution holding it gets into trouble? Because the answer to that question, the real answer, grounded in the legal framework and the financial architecture of 2026, might be different from the one you assumed.